Hi everyone, my name is Ana Barata and I'm a research associate at the Florence School of Banking and Finance. And today we're going to talk about bank resolution objectives. So, bank resolution can be described as a specialized regime for bank failures. In the EU, the two key legal documents to have in mind are the Bank Resolution and Recovery Directive, the BRRD, and the Single Resolution Mechanism Regulation, the SRMR. Jointly, they are usually referred to as the EU Resolution Framework. Articles 31 of the BRRD and 14 of the SRMR list the 5 bank resolution objectives. First, to ensure the continuity of the critical functions of the banks. Second, to avoid significant adverse effects on financial stability, in particular by preventing contagion, including market infrastructures, and by maintaining market discipline. Third, to protect public funds by minimizing reliance on extraordinary public finance support. Fourth, to protect depositors and investors. And fifth, to protect client funds and client assets. All the bank resolution objectives are on paper of equal significance and must be balanced by resolution authorities on a case-by-case scenario. However, this case-by-case balancing exercise might raise some controversial trade-offs. Let's briefly unpack each of the 5 bank resolution objectives. The first objective of bank resolution that is included in the EU resolution framework is to ensure the continuity of critical functions of banks. So what are critical functions? Critical functions are structured sets of activities, services or operations that are provided by banks to third parties at the national level, such as payment systems including ATMs, deposit takings, granting loans, or clearing services. What makes these functions critical? To be classified as critical, these functions cannot be interrupted without having a material negative impact on third parties, giving rise to contagion and undermining the general confidence of market participants. So why is ensuring the continuity of critical functions of banks an objective of bank resolution? To avoid the disruption of services that are essential to the real economy and which could potentially threaten financial stability in one or more member states. The second objective of resolution intends to avoid significant adverse effects on financial stability, in particular by preventing contagion, including to market infrastructures and by maintaining market discipline. This resolution goal has 2 components, the mitigation of contagion and the protection of market discipline. So first, avoiding contagion among banks minimizes the impact of the failure of the bank itself and does not ensure the continuity of provision of the bank's critical functions that we just mentioned. And why is the mitigation of contagion a bank resolution objective? The idea is to prevent spillover effects through financial markets, in particular to avoid panic runs. Second, the protection of market discipline aims to internalize the cost of protecting banks by creating incentives for their shareholders and other stakeholders. And why is the protection of market discipline a bank resolution objective? It in fact aims to split the restructuring costs between the state and those who invested in the bank, namely the shareholders, subordinated debt holders, and also senior creditors. The third objective of bank resolution aspires to protect public funds by minimizing the reliance on extraordinary public financial support, once the bank is insolvent and declared failing or likely to fail. In simple terms, the objective aims to reduce the use of taxpayers' money. So the general rule included in the EU resolution framework is that the provision of state aid to a bank depends on a decision to put a bank into resolution first. And why is the minimization of the use of public funds a bank resolution objective? It's very simple. It aims to restrict the cases in which publicly financed banks can occur. So to say, to reduce the number of cases in which publicly financed bank bailouts can happen. The fourth bank resolution objective is to protect depositors and investors. So why should depositors and investors be protected? In a resolution process, the depositors and the investors invested in a bank hold an investment risk. And this means if the bank is insolvent or resolved, their instruments might be lost. Depending on the size of the losses of the depositors and of the investors, the investment risk may represent a threat to financial stability. So it is important to combine the protection of financial stability and the protection of depositors and investors. A comprehensive reading of the BRRD and the SRMR provisions dictates that during a resolution process, depositors and investors might lose their investments through bail-in operations as long as their losses do not harm the stability of the entire financial system. The size of the bail-in is a very important public policy decision because it determines which investors participate in the losses. Depending on who is exposed to these losses, it can be classified as a junior debt bail-in or a senior debt bail-in. Finally, the fifth bank resolution objective aspires to protect client funds and client assets. An extensive interpretation of this objective would allow the protection of all assets and funds. However, this was probably not the initial idea. This objective plays a substantial role under the current regime due to the potential application of bail-in tools or possible exposure to losses. From a public policy perspective, this objective also entails a complex trade-off because it may conflict with the need to prevent systemic contagion and to protect public finances. So to conclude, I would like to say that the bank resolution objectives established by the EU resolution framework are too broad, and this may block the convergence of practices across member states. And why so? The maximization of certain bank resolution objectives may, under certain conditions, be detrimental to the accomplishment of other objectives. This may lead to the conclusion that the resolution objectives are equal on paper, but that some are more equal than others. This unequal importance is possible because resolution authorities balance the implementation of the resolution objectives on a case-by-case basis. Bank resolution objectives combine several public policy considerations and seek to achieve rather heterogeneous goals. To conclude, the bank resolution objectives included in the EU resolution framework are too broad, which may block the convergence of practices across the banking union.